Time now for Christine Poole's top picks. Number one on this day, a giant of Wall Street, perhaps the giant in many people's opinion, JP Morgan Chase, JPM.
That's right, Paul. So we own JP Morgan, and it's really the only U.S. bank we've held for a number of years in our client portfolios. Like you said, the largest bank in the United States and probably one of the largest globally, run by a very excellent management team that's kind of outperformed through the cycle. The company reported their earnings a week Friday ago. We thought it was very solid results, increase in earnings, increase in net interest margins. Their base case is no longer that we're going into recession where it was about a year ago, probably some sort of slowdown. And, you know, they have a stellar balance sheet, what they refer to as a fortress balance sheet. And that really is what probably enabled them to buy First Republic back in May, when the regional banking crisis occurred. Like, typically, I don't think JP Morgan would have been allowed to buy any other financial institution because they are so large.
Right.
They have the number one share in retail deposits, number one in investment banking. But given the turmoil we saw, they put in the best bid, and that's been very accretive for them. It's going to contribute to earnings going forward. Best productivity ratios in terms of their overhead gives you a yield of about 2.5%. So we continue to like it.
Okay. Number two, RTX Corporation, ticker symbol RTX in New York.
So RTX is half defense, which is Raytheon, and half commercial aerospace, which is Pratt and Collins.
Is this the former Raytheon? Is it renamed as RTX?
Correct.
Right.
Paul.
Okay.
Yeah. So the stock has underperformed this past year its peers because of the problems they had on the commercial aerospace side in terms of Pratt. There were some metal impurities in their manufacturing process for one of their engines, which they've since rectified. They discovered the problems, and all the engines built post-2021 are fine. And what they're, what's been going through their process, they realized that they're going to have to bring the older engines sooner and longer for maintenance and inspection, and that's going to impact the company in terms of cash flow. They sized it; it's about $3 billion net to Raytheon. I know the stock came off on that, but I think it's reflected in its share price. Eventually, I think they'll come out of this. And, meanwhile, commercial aerospace travel continues to grow. The defense side, given all the geopolitical turmoil and conflicts around the world, defense companies have done quite well. They have a very strong backlog. They make missiles, sensors. So we think that, there's still some margin improvement possible on the defense side. They had some problems in terms of their supply chain and some contracts. So going forward, as these are kind of behind them, we should see some margin improvement. So they've lagged. The share price, I think the valuation is quite attractive here. It gives you yield in excess of 2%. So we remain shareholders and we'll be buying it here.
Okay. WSP Global is top pick number 3 today, ticker symbol WSP on the TSX, a pick in the engineering construction realm.
Yeah, so they do engineering design and services. So they actually don't do construction, which has kind of been the area where these companies get in difficulty with. So that's one of the reasons why we added this company to our portfolios a few years ago. So they grow through by acquisition as well as organically, and they've made a few very attractive acquisitions the last couple of years that has expanded their presence in the environmental area. And so I think that's a growth area. They're very big in transportation infrastructure, so they'll be beneficiaries of the Inflation Reduction Act in the United States this year, where they're promoting infrastructure spending, and they have a very strong balance sheet, so they will buy opportunistically, and they will walk away if the price gets too high, and they've done that in the past. So we think this is a long-term attractive growth area. We like the very strong management team, and because of the acquisitions they've done the last few years, their organic growth rate is actually quite attractive as well. So definitely, we like the fact they're not in construction, very global. Canada is less than 18% of their earnings. And even though it's done well the last few years, we would still be buyers here.
Okay. Christine, thank you so much for joining us. Always great to have you buy with us. Our viewers really appreciate your insights. Her top picks again, Christine Poole's top picks again, JP Morgan Chase, RTX Corporation, and WSP Global.
Texas, TCS on the TSX. And remind us what they do, Stephen, please.
Right, so they're a Montreal-based company that develops and sells supply chain management software solutions, mainly for healthcare networks in the U.S., so hospitals and clinics, which is a segment they dominate, as well as to complex distribution businesses, for example, like auto parts companies and so on. And they provide an end-to-end solution. So from purchase order management and fulfillment to inventory and warehousing to accounting and analytics. And we recommended this stock in 2019 at $15, and it's one of the top 30 performers on the TSX, reaching $60. But it sold off hard during the correction in 2022, and also because of this flight out of stocks that I mentioned earlier on, despite them doubling their revenues in the past 4 years and growing their high margin recurring software as a service revenues to 60% of total revenues. So Texas is a profitable company, but they've been reinvesting in organic growth because there's so many opportunities. Like I said, they dominate the U.S. Healthcare market, and it only trades at about 2.5 times revenues, whereas their peer group trades at significantly higher multiples. And yes, they could stop spending on growth and become much more profitable tomorrow morning, but there's too many growth opportunities ahead of them. So this company is really a real gem and is worth significantly more than it's trading at today. And we think down the road, a strategic buyer is going to make a very attractive offer to the main shareholders at some point. But right now is a great time to get in because the valuation is still very depressed versus the tremendous results that they've been announcing lately.
Your next idea, Park Lawn, the funeral services company.
Right. So Park Lawn owns funeral homes, cemeteries, and crematoria in Canada and the U.S. It's a recession-proof business, high barriers to entry. And it's very well run out of the U.S., out of Texas, by a great management team there. The stock, rose to over $40 in 2022 when the revenues surged from the higher death rates from the pandemic, and they were added to the TSX. But the stock has really pulled back to under $20 for a couple of reasons. Obviously, very difficult year-over-year comps, a flight out of the small mid-cap stocks, and there was some concern over some leverage. They were going to team up with Brookfield to buy a huge competitor, so people got a little nervous about that. And then they got kicked out of the TSX, which of course really drives the stock down. So the stock has never been cheaper in terms of valuations, trading at about 8 times EBITDA, whereas their U.S. peer Service Corp's trading at over 11. They're buying back shares. So it's a great opportunity to get in. There's going to be some big catalysts coming. They just sold a lower margin business for a very good price. So you're going to see margins really grow over the next few quarters. And then with an improved balance sheet, you'll see them be more aggressive on the acquisition front because it's still an extremely fragmented industry.
So they got dropped, that is from the composite index, Stephen.
Yeah, when you get put in, your stock goes through the roof, but when you get kicked out, the opposite happens too. But it creates a great buying opportunity. So I think this company is going to do really, really well over the next few years.
And then your final idea is Quebecor, which is building or wants to build market share in wireless services nationally.
Right, so we talked that telecom stocks are cheap. Well, this one's the cheapest of the lot, but has the best growth prospects. They're a dominant cable provider in Quebec, but 4th largest wireless player in Canada now. And they benefited tremendously from Rogers acquiring Shaw and then having to divest of Freedom Mobile on very attractive terms to Quebecor. They also bought Spectrum on the cheap, and they're benefiting from a very favorable regulatory regime where new players can buy at wholesale rates from the incumbents. And this is allowing Quebecor to expand into Ontario and Western Canada with much lower capital expenditures than the market expected. They're generating very strong free cash flow, and their leverage is expected to come down to the point where their debt is probably going to get upgraded to investment grade by year end, and that'll be a huge catalyst, not for the bonds, which we own a lot of, but also for the stock. They have 40% EBITDA margins, highest return on equity of the group, and the best growth potentials. And it's trading at about 6.5 times EBITDA, and BC's at 8, and Telus is roughly at 9. We think wireless competition in Canada is going to remain disciplined. It's still an oligopoly. And we've talked about BC before, and even TELUS that they're great buys with the dividend yields at 6.9% and 6.1% respectively. So just a great sector, but we think Quebecor is the one with by far the most upside.
Stephen, always great talking to you, and thanks very much. Let's get to those top ideas. Dassault Systèmes, involved in design and other things.
French company. We sort of had to dig around because as we take profit, we have to look for these other companies that have longer runways. Now, mind you, it isn't a long runway. It's about 20%. Currently trading right just above $50. We have a 12-month price target of $59.50. 12-month price target. So they're a global provider of software solutions and services for products, for design, for engineering, for natural resources, urban planning, and even into the chemicals and materials side. So, as I mentioned, but now with the this is a great example of actually incorporating and making a company more profitable and better products and services. So they've actually integrated generative AI into their software, and it automates and optimizes the whole design process. I remember sitting here with you, oh gosh, this would be 5 or 6 years ago, talking about Dassault and digital twins. Remember, you could have a machine on a factory floor, and then you could pull up the machine on your screen. Well, what they've done now with generative AI is that you don't have to have the machine. You can actually build the machine on your screen. So they do it for predictive maintenance and manufacturing, customization, personalization of customer data, simulation and testing, especially over into that, as I mentioned before, about chemicals and materials experiences. So it's an interesting company, somewhat missed. It is an ADR, but it's actually sponsored on the New York Stock Exchange, so it has good liquidity. Buy it here just over 50. If you can buy it down closer to 48 and then closer to 45, I think you'll do well over the year.
Nvidia, we talked quite a bit about it. Just give us one other fact on Nvidia, why you like it.
Well, I mentioned before that they have 80% market share in the discrete graphic processing unit. But then also with this, maybe I'll just sort of talk about, because they made quite a splash actually at the Consumer Electronics Show in Vegas a couple of weeks ago. And it was phenomenal to see them, all the products that they were bringing out. So they brought out a new GeForce Super Desktop GPU, not just for desktops, but also for laptops. And then they added to that AI software and tools. Then they brought out Tensor. And so I guess the last tidbit I'll tell you about is it was just announced a couple of days ago that Meta, Mark Zuckerberg, bought 350,000 of these Nvidia H100 GPUs.
Wow.
350,000.
A third of a million of them.
Now, if you and I were to go out and purchase one of those GPUs, it's about $38,000. I'm sure he got a discount on it, but he bought 350,000. So I guess the moral of the story is that this AI revolution is still in the early innings. And you can still buy the vendors, and you'll see the impact into the end users. Yeah.
Okay, your final idea is Adobe.
Yeah, I haven't mentioned this one in a while, but so this is sort of the one-stop shop for product design, content creation, marketing, web and mobile commerce. Currently trading it's around 615. And it still has a bit of a, 614. It still has some runway in front of it. we have a 12-month price target of 672. And likewise, they have so many developments going on in artificial intelligence and the image generating technology is integrated into, for example, Photoshop. And then they just brought out this thing called generative match, which allows users to actually generate images based on text. So you don't have to play with it, but you can actually talk to your AI and say, "This is the image that I like," and boom, up it comes.
Wow.
So they're just, and then they brought out a lot of new things. For example, this is one. So they teamed up with the Australian National University, and they've developed this AI model called LRM that can transform a single 2D image into a high-quality 3D model in just 5 seconds. So you can actually take something that is two-dimensional, talk to the AI chatbot, and it will actually change it into a high-quality 3D model. So it is working, and there's going to be a lot more coming out. So with Adobe, we still see some runway in front of it, up to 672, so you could buy it down here. I'd also buy a third here, buy a third down at 580, and another third down at 550.
Ken, thank you very much indeed.
Great to be here.
Kim Bolton, our tech guru, right here on Market Call. Okay, let's get to those top picks. Number one, Parker Hannifin, engineering company, vision systems, things like that.
Yeah, and they're expanding into aerospace, things like airplane doors, which apparently have been in the news the last little bit. So their growth, again, we're into the bricks and mortar, how does one say, picks and shovels type technologies. So they make a lot of the technologies possible, and aerospace is a high growth industry for them. They've grown both organically but by acquisition. One of the things we like about them is historically a lot of their contracts was more shorter term, and they've gone more toward long cycle agreements with their customers. So the shift in the business, the acquisitions, the focus on aerospace, I'll think it'll be. We tend to pick these for these ones, companies that are not necessarily in the news, not necessarily inherently exciting. I mean, how exciting is hydraulics? But there's a lot of good money to be made in this kind of company.
Okay, and then Applied Materials, an indirect play on the chip sector.
Yeah, so they supply to Taiwan Semiconductor. They actually do make things, but they make the things that make the things, which power the things that we all use. So they make the machines, the structures that enable those great big wafers that they make the chips out of to get made. And as the technology gets more and more and more complicated, and as well as the onshoring of chip manufacturing here in North America, the demand for their products, for Applied Materials products, I think is just going to continue to increase. So not as, I can't for want of a better word, sexy, not as sexy as Nvidia, but if they're going to be making chips here on this side of the Pacific Ocean, this is a company that stands to benefit.
It is incredible, isn't it, how governments have decided we need to have these factories within our jurisdiction now.
Well, it's also fascinating how long they seem to be taking and how difficult it is for, say, Taiwan Semiconductor to actually build a flak factory in Arizona. They benefit, Taiwan does, from the Silicon Shield, knowing full well that America and the rest of the West can't let Taiwan be forcibly absorbed into China as long as all the semiconductors that we need to power our lives are made in that island. So I think it may be a while before they actually have too much in the way of semiconductor production in North America, just because transferring that expertise off Taiwan is not necessarily in Taiwan's best interest.
It's interesting, isn't it? Yeah. And I wonder, in some industries you hear that the Chinese have built up such a lead now, not chips, but other industries, green power, electric vehicles, that we're a decade behind them now.
Maybe, But it's often said of totalitarian regimes that, oh, they're so far ahead. I mean, look at that Mussolini guy. He's got the trains running on time. So I think the jury is out. I mean, America, for all its faults, has the ability to renew itself and to innovate. Consider the patents, the Nobel Prizes that come out of America over against the rest of the world. My bet's still on the US of A.
And there are those who say, historians, that the Nazi economic miracle was just an illusion. It was a house of cards.
Well, they did. I don't know. That's why I picked Mussolini, because I'm not going to be in a job of defending the Nazis.
No.
We've already covered bread price fixing. That's enough for one show.
We've dealt with that. TransUnion, the big credit reporting company.
Yeah. Now you would think that in a difficult economic environment that TransUnion would benefit, because everybody would be checking people's credit ratings, but you don't have to check people's credit ratings in a difficult economic environment, because the banks just don't lend you any money, so they don't have to check your credit rating. They're just not going to lend. It's more in a resurgent economic environment where the banks are actually lending money. So if you're betting on a soft landing or a stronger economy than maybe people would have thought with all those massive interest rates from last year, TransUnion could be a good bet as a way of, it's not quite picks and shovels, but it is a provider to the banking industry that does well when banking does well.
Right. I see the stock, maybe we could look at the 5-year chart again. The stock is off its highs. I wonder, are people worried about a lack of credit growth and slow growth in lending?
Yeah, so that's what I'm saying. That's why I'm suggesting it for a now.
Sure.
I mean, so many of the stocks, like we talked about Cameco, we've talked about so many of the stocks that are doing great. This is a stock that actually does well in a better economic environment, even though its business is helping to figure out how good somebody's credit is. Again, bad economic environment, nobody cares, nobody's lending money.
We're going to leave it there. Brendan, always fun. And I don't think you would ever defend the Nazis.
Okay, why did we have to go down that hole again?
I know, let's not even
That's
go
why
there.
I picked Mussolini, because, he's
less obnoxious.
There we go.
Okay. First idea, the Horizon Seasonal Rotation ETF. And of course, Brooke Thackeray, a frequent guest on Market Call, is involved in that one.
Yeah, shout out to Brooke. I really love the Horizons Rotation ETF. HAC is the ticker, lovingly known as HAC. And it's nice because it's different, right? A proprietary seasonal rotation investment strategy that looks at a broad array of asset classes, because seasonality in stocks, everyone's probably heard the sell in May and go away, but it's different in oil and it's different in gold, and it's different in different asset classes with different market participants. So you've got a broad array of potential asset classes, and you've got this different way of looking at whether to be long or short or have a high cash position. So it gives a very different feel to the portfolio. Again, I think it's going to be critical to manage risks. And this is just a different way to have a lens on moving through a portfolio landscape. So I think this is a very complementary portfolio or addition to sort of the general 60-40 portfolio.
Right. I'm just looking. It has matched the TSX over 3 years, and it has outperformed a bit over 1 year, the past 1 year, but it looks like it has lagged over 5 years. But as you say, it's a different way of investing. I don't know what I'm trying to say here, but it's a diversification vehicle.
Yeah.
Sorry. Your next idea is the Cambria Foreign Shareholder Yield ETF. Now, where does this one trade?
This one trades in the U.S., so it trades on the CBOE, but basically a U.S. exchange. And it focuses on the free cash flow of a portfolio of stocks. Remember, we want to make sure that the stocks we're buying aren't these overvalued darlings. And so one thing to do is look beyond the North American borders into foreign stocks. The other thing is, when you're owning companies, let's look at not only the dividends they pay, but we want shareholder yield, not just dividends. And shareholder yield can manifest through three processes. One is dividends. The other is buying back debt. And lastly, the other is buying shares. And when you look at the total yield of the top stocks that are in the shareholder yield screen, what you see is double-digit yields. So if you combine their dividend with their share buyback, with their purchases and net debt pay down, you'll get 8, 9, 10, 11, 12% expected yield from this portfolio of stocks, and they're not overvalued. They offer this in emerging markets, which we talked about in my last visit. And we spoke about it on the US side for one of the callers earlier today. And this is a way I think that you can really separate with the wheat from the chaff, because free cash flow, if you don't have free cash flow, you can't do any of these things. So it's a good check on the fundamental strength of the company.
And then finally, the Harvest Healthcare Leaders Income ETF, unhedged HHL.
Right, and this one, it's got a little bit of a covered right. We did cover in my last visit the evolve version of this. And again, healthcare, I would say, is a lagging area of the market that would probably be due for some catch up here. And it's an equally weighted portfolio of the 20 largest global healthcare companies. And so you've got very large companies, you've got the tailwind that comes with being in healthcare, aging population, the advancement of AI, the advancement of medical technologies. And in order to generate a little bit of yield, they do a covered strategy on a covered writing strategy, but only on about a third of the portfolio. So you're getting a little bit of income to enhance the portfolio's income across a covered call writing, and you get 2/3 to take advantage of the long-term growth prospects of this area of the market.
And the covered call, I mean, it does complicate things. Would you have a preference? I guess it depends on the investor, between an ETF that does covered calls or just holds stocks in a straightforward way.
Well, if I didn't have an income yield requirement of some kind, then I would just hold the stocks, because the covered writing, while it produces some income, it generally in the long term, in the very long term, doesn't really pay off. If you look at, sort of full market cycles, 10 to 20 years, there's a cost to it, and you're always giving up the upside. But some investors do want to have a regular yield from their portfolio. And this is why I say, well, we make a compromise. You have a portion of the portfolio that sells a little bit of those covered calls, and at times it will be beneficial. When you're writing calls on a portfolio that is kind of flat or slightly up or slightly down, that can help. If you're writing calls on more volatile asset classes, such as gold stocks or metals and mining, things like that, that can provide a little bit more premium, again, a little bit more income, reduce the volatility a little bit, and provide income in areas of the market that don't often have income associated with their stocks. So, there are ways and means and investor preferences that might conclude for some of the portfolio having covered right. But, let's keep the majority of it not.
Okay, let's leave it there. Mike, thank you very much indeed. Simple can be best. All right, Mike Philbrick, the one and only. I really appreciate it.